All right, fantastic. Everybody, welcome back to the Crypto Power Hour. We are here every Thursday at 11 a.m., and we're talking about one of our favorite subjects that we like to talk about around here, and that is tax loss harvesting. So I do have Andrew here with me again today, and we're going to kind of go through some of the best tips and tricks when it comes to tax loss harvesting. Andrew, are you excited?
Yeah, I am. I'm very excited because I'm often asked, probably every single day, what are some strategies to decrease my taxes when it comes to crypto? And tax loss harvesting is a strategy that pretty much everyone out there can use, and it can have a meaningful impact on your crypto capital gains for the year and ultimately your taxes as well. So I am pumped to talk about it today.
That's great. It might be a bear market, but this is something that can hopefully turn your frown upside down. Uh, my favorite thing that I love to say around here, a disclaimer, none of this is financial or legal advice. So we will jump right into it here. Uh, bu- 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 First thing I want to touch on are wash sales. Exactly. What are they? How do they work? Break it down for me, Andrew.
Yeah, and actually, before we jump into wash sales, if you don't mind, I do want to share just one quick update that was in the news. The Financial Accounting Standards Board, the FASB, four-letter agency that a lot of people have probably never heard of, does have a large impact in the business world and how business financial statements are reported. And the FASB has issued guidance that crypto assets should now be valued on the balance sheet of business financial statements at the fair market value. So historically, companies like MicroStrategy or Tesla that held crypto on their balance sheet were reporting it as what's referred to as an indefinite life intangible asset. And as such, they had to report it at the cost basis on their financial statements unless the price went down, then they could test it for impairment and decrease the price on their financials. But if the price went up, it wouldn't increase their position until they sold it. And so now the FASB has said, wait, companies, you can do it differently. You can now value it at fair market value. And so if the price went up, then you can also reflect that on your financial statements on your balance sheet as well. So for a lot of people, this is pretty big in the world of crypto, especially for businesses, because some people, such as Michael Saylor from MicroStrategy, think that this will incentivize businesses to hold crypto on their balance sheet because of this more favorable type of reporting. So I just wanted to quickly mention that because it is pretty big news.
No, completely right. I'm very glad that you did share that with us. Is there
But
anything else
yeah,
is there anything else you want to add on that?
no, that's all on that point.
Okay,
But now, happy to jump into your question
sure.
on tax loss harvesting.
Yeah.
And so you had asked, what is a wash sale? And so a wash sale is when you sell a stock or security at a loss, and then you buy it back within 30 days. And in the eyes of the IRS, this is disallowed or considered a wash because you sold it, then you bought it back, so we're not going to give you that capital loss from that initial sale, as long as that happens within 30 days. And so that's a wash sale, and it applies to stocks or securities.
And I'm curious, Andrew, how does crypto kind of it's like the outlier. It doesn't the crypto doesn't fall under this wash rule. You could buy your crypto, you could sell your crypto, you can buy it back, correct?
So that's a great question, Jacob, and it's kind of a gray area, but one that has become a little bit more clear over time. And so the tax code that refers to wash sales literally says stocks or securities. So then that raises the question, well, what is crypto? Is crypto a stock or security, or is it none of the above? And how should we interpret it? In a lot of areas of the tax code, we apply much the same types of rules to stocks or securities that we do to crypto, although, again, most crypto, not necessarily securities. But here, the code specifically says that. And so many practitioners have uh, viewed that the wash sale rule does not apply to crypto because crypto is simply property. and the wash sale rule doesn't generally apply to property. That was generally viewed as a more aggressive approach because, again, there's no clear guidance, and sometimes we treat it like stocks, sometimes we don't. But then recently, Congress, there's a bill, I can't recall the name, I think it was the Build Better Act. I forget the acronym now. But in that bill, there was an attempt to have the wash sale rule now apply to crypto. And so if you have Congress trying to update the law to clearly apply to crypto, you can infer from that, well, in the absence of this law change, the wash sale rule doesn't apply to crypto. So it's not explicit, and you should certainly talk to your tax professional about this position. But many people, many practitioners do view that the wash sale rule doesn't apply to crypto, at least under current law.
Okay, now what about NFTs?
So NFTs are a little bit different. So with cryptocurrency, it's fungible generally, right? Bitcoin, one piece of Bitcoin, no different than another piece of Bitcoin. If I sold Bitcoin today at a loss to someone, and then tomorrow I buy Bitcoin from someone completely different, it doesn't matter to me. That Bitcoin is still Bitcoin. It was no better or worse because I got it from a different person. But NFTs are different. They're non-fungible. They're unique. And so in order to even conceivably have this occur, you'd have to sell your NFT to someone and then buy back that same one. And maybe you could buy it back from that same person. Maybe it's changed hands. But here, just from a technical standpoint, you're buying and selling something that's non-fungible. And so for most people that are selling NFTs, they're not buying it back. They're not taking advantage of the wash sale rule, but they are harvesting losses. And so one question that does often come up as well is, well, what if I sell my NFT to my friend and then he agrees to sell it back to me a day later for the same price? Can I now harvest that loss? And in our view, we don't think that the IRS would view that as a transaction and would not consider the first sale to your friend as an actual capital loss. It's really just a sham. It's for no purpose other than to generate a capital loss. And also there is no exposure to risk in price fluctuations or any risk at all because you had a agreement to sell it back at the same price, even if it's a different price. Even then, the IRS likely would view that as a sham transaction, disallow it. So NFTs, for the most part, you can harvest losses, but in terms of taking advantage of the wash sale rule, it gets kind of iffy. Definitely an area to talk to a tax professional about.
No, I'm also curious, only because how would the IRS go about kind of looking into if you're shamming this wash NFT?
So with NFTs, it's if anything, a little bit easier because on its face, each one is unique. And it's just unusual for someone to sell one specific NFT and then buy it back on an open market. It does happen, right? Some people do that. But if it's on a market, often then other people may buy it or that price will be much higher. So it's possible. But a bigger risk factor would be that you don't do it on something like OpenSea, but instead you sell it to a friend. So instead of going through, and the blockchain shows all this, instead of going through a platform like OpenSea, you just have a transfer from one wallet to another, and then it transfers back. And the IRS has gotten better and better at reviewing crypto activity, identifying taxable and non-taxable events. And so just on its face, we would be able to see when reconciling your crypto, hey, you transferred this NFT out, there's a unique identifier to this other wallet, then that other wallet sent it right back, which doesn't seem to be really a sale and then another sale and a buy. It just seems to be a back and forth.
No, that's a perfect answer, exactly what I was looking for. I feel like a lot of people, especially when it comes to crypto, they're like, everything's decentralized. The IRS is not going to find it. But like you just said, it's on the blockchain. They can see it. They can go look it. They can pull it.
It is on the blockchain. And, I hate to talk about how easy it is for the IRS to identify crypto activity because a lot of people, unfortunately, have their head in the sand and they're trying to ignore the IRS and not report crypto. But nowadays, it's become easier and easier for the IRS, and they're also getting a lot of information. There have been what's referred to as John Doe summonses issued to exchanges, where these exchanges now have to basically provide all information on all users that fall under certain criteria. Most recently, there was another smaller platform called SFOX that also received one of these summonses. And this is an indication that the IRS is not only going to get data from the large exchanges, but also smaller platforms, smaller data brokers as well. So the IRS is getting a lot of information. They're also getting better at identifying the non-reporters of crypto with that information. And then when auditing clients or even criminally investigating, I shouldn't say clients, but taxpayers in general, the IRS is getting much, much better at the technical aspects of reviewing the blockchain, even side chains and different privacy tokens as well. They're very familiar with these things now.
I couldn't agree more. And I know they also, I mean, it's just easier and easier for them to track everything down. And everybody who's watching, if you do go to our YouTube channel, which is youtube.com/Gordon Law Ltd, I know for certain we have an entire video that explains all of the different ways that the IRS can track your crypto. Now, going on to my next subject here, I want to know, when is the best time to practice tax loss harvesting?
Sure. So maybe first let's talk a little bit about what tax loss harvesting is. So we talked about the wash sale rule, which for purposes of conversation, let's assume that the wash sale rule doesn't apply to crypto. And so in that case, you can sell crypto at a loss and then buy it back within 30 days and still have that loss. Why would you want to do that, or might you want to do that? Well, by capturing that capital loss, you can use that capital loss to offset future capital gains or even income up to $3,000 a year. And so for many people, they look to harvest losses on certain tokens at certain times when the market is down, then buy back. And then if they sell other tokens later on at gains, well, then they've already have these losses to offset those gains. And so it's often a good strategy in order to accumulate losses that then you could use later on to reduce your gains. That said, it's not always the right thing to do. So there are some times when harvesting losses wouldn't make sense. For instance, if you're planning on selling that crypto in the short term, again, at a gain, then you've reset your holding period by selling and perhaps buying back. And one of the other best tax strategies out there for crypto is to sell long-term, after you've held the crypto for at least a year. The long-term tax rates are about half of the short-term tax rates. Long-term being typically 15 or 20%, and short-term tax rates, depending on your overall income, can be 30% or even more. And so by holding for longer than a year, you're able to have these lower tax rates. But if you sell your crypto and then you buy it again, you've reset your holding period, and you now need to wait another year before selling again. So it's prudent to look at your portfolio overall before you start harvesting losses and start to consider what the future moves may be. Because you might have one token that you're not planning to sell, or you don't envision selling for a while, but it's still at a loss. And maybe you'll harvest that one. And another token, you'll have a long-term gain that you'll be able to, that you plan to sell later on. And that way you'll have that gain and have that loss from a different token. So it doesn't always make sense, requires a little bit of planning, but tax loss harvesting could be a very valuable strategy to minimize your overall tax exposure.
No, I'm curious because you did mention the limits of being 3,000. What happens if you go over that?
Yeah, so capital losses can be carried forward indefinitely, at least under current law. So if you don't use all your capital losses this year to offset capital gains, then they can be carried forward to next year or future years. But before they're carried forward, you first get to take up to $3,000 against your ordinary income. And so if you have W-2 or mining income, then you can take $3,000 of that capital loss to offset that. But $3,000 isn't that high. In fact, if you have, for example, staking rewards that are very significant, and then you sell at a loss, have a capital loss, that staking reward income is only going to be offset by $3,000, which may not make much of a dent in it. The remainder of the capital loss is going to, again, be carried forward to future years. It's important to know that capital losses can't be carried back. So if you have, for instance, losses in 2022, which many of us unfortunately have, and you have gains in 2021, which many of us either fortunately or unfortunately have, you can't take those losses from 2022 and bring them back to 2021. Can't do it. But you can take 2022 losses, if not used in the current year, to 2023 and future years to offset those gains. So we're getting calls from many people that have losses now and still owe taxes for 2021. But unfortunately, under current code, under current law, those losses right now aren't going to change the tax owed in prior years.
No, that is really, really important to know that you can't carry anything backwards. Now, I don't know if you mentioned or glossed over this, but I'm curious, what's it look like if I bought crypto at multiple price points?
Sure. And so many people do exactly that, which is dollar cost average or buy crypto at various different times at various different prices, which, again, many people do. That makes it harder when you start to consider tax loss harvesting because you'll have to track all of those different volumes and prices because when you sell, typically you'll apply first in, first out, or FIFO, meaning the oldest crypto is the first crypto that you'll sell. And so if you just bought, for example, Bitcoin a week ago, and it's already dropped in price 10%. However, maybe you've got some Bitcoin that you bought a year ago that was at $10,000. If you then sell now, even if you plan to sell, hey, I want to sell that Bitcoin that I bought a week ago, what would typically be used is FIFO, and instead it would be the first Bitcoin that you were sold a year ago that would calculate your gain or loss for tax purposes. And as a result, in this example, maybe you bought that Bitcoin a year ago, and this is actually horrible prices, say 5 years ago at $10,000, and now you sold it and it's 20. Well, you've got a capital gain, even though the Bitcoin maybe you bought last week was at 22,000. And so it's important to know that it's generally the oldest crypto that you're going to be selling first rather than the newest or even the highest purchased value. There are some exceptions to that. So it's important to talk to a tax professional to see if it's possible to use what's referred to as specific identification. But in most cases, FIFO would be applied, and that's what the IRS would expect on a tax return.
All right, Andrew, I think we plowed through everything that I wanted to cover rather quickly. Is there anything else that you want anybody else to know? Any kind of tips, any other tricks?
Yeah, so I think it's just worth mentioning, we're getting towards the tax return extension deadline, which this year is October 17th. It's coming up in just a few days. And one of the topics that we've been talking about through this entire video is that the market is at a low, at least over the last year or so. And so perhaps you don't have the crypto or even the cash to pay your taxes. One of the most important pieces of advice that I'd give everyone out there is that it's still crucial to file the return. Because if you don't file, then there are failure to file penalties, in addition to failure to pay penalties. But not filing itself has a penalty. And if you just don't have the funds available, there are other options available. For example, payment plans. Believe it or not, the IRS is very willing to enter into a multi-year payment plan to pay your balance. There is interest, there is penalties. But for a lot of people, that's better than liquidating all your holdings now at a loss in order to pay your taxes. So there are options out there. But one of the things that often doesn't make sense to do is just not to file at all or ignore the tax return deadline.
Again, very important information to know. And if anybody needs any sort of help or anything, always reach out to a tax professional. Andrew, I think that's all that I have for today. I want everyone to make sure to go to our website, check out our blog. We have multiple blogs. I'm 100% positive talking about tax loss harvesting. We also have a crypto tax guide that can help you through all of your crypto taxes. It's the only thing that you need. Print it out, put it underneath your pillow. Every Thursday, we are going to be here at 11, same time. Again, I want to thank you, Andrew, for taking the time out of your day to do this. And everybody else, if there's any comments or anything. Oh, I do actually see one. Always do your taxes. Nice stream.
Good advice.
Couldn't have said it better. Again, everyone, we do appreciate that you watch. If you have any questions or anything like that, please feel free to put them underneath the video. You can also follow us on Twitter. I'll put our Twitter up there as well. And I think that's all I have for this week. We'll see you guys next week.
See you, everyone.